Humans have created many tools to measure value, manage risk, and organize economic life. Despite this, the same economic misconceptions keep appearing across different times and places. These illusions survive wars, revolutions, technological advancements, and scientific discoveries. They are not just mistakes caused by ignorance. Instead, they are patterns rooted in psychology, incentives, power, and collective memory. Every generation believes it has finally escaped the mistakes of the past, only to repeat them in new ways, under new names, with new excuses. One of the most common illusions is the idea that value can be created without cost. From the ancient practice of lowering coinage standards to modern monetary expansion, societies have convinced themselves that minting, or creating money digitally can replace real productivity. Roman emperors reduced the silver content of the denarius to fund armies and public projects while claiming stability. Medieval rulers often clipped coins. Early modern states issued paper notes that were backed by little more than promises. Each time, the illusion lasted briefly, just long enough to finance political aims, before prices rose and trust broke down. The issue was not poor math, it was the refusal to accept that money is a claim on resources, not a resource itself. Another enduring illusion is the belief that speculation is different this time. Previous speculative bubbles, whether with tulip bulbs in the Dutch Republic, railroad shares in the 19th century, radio stocks in the 1920s, or internet companies in the 1990s, follow a familiar pattern. Prices rise, stories spread, skeptics are dismissed, and participants start to confuse rising prices with real value. Each cycle brings new terms and new stories, yet the underlying psychology does not change. People don't buy assets just for their production. They buy because they expect others will pay more in the future. When that expectation fails, the illusion disappears quickly, resulting in real losses. Related to this is the belief that markets operate purely based on logic. Economic theory often assumes that informed actors make sensible choices, yet history shows that emotional factors, social pressure, and imitation influence outcomes just as much. Much as data, financial bubbles are social events. People see their neighbors getting rich, fear missing out, and twist evidence to support their optimism. This behavior isn't irrational, it's human. Still, each generation thinks that better information, quicker communication, or smarter models have removed the risk of mass delusion. Instead, these tools often strengthen it. Governments also fall into recurring illusions. Many believe that debt can keep growing without consequences. Empires, kingdoms, and republics have financed wars, welfare, and prestige through borrowing, often hoping future growth will cover today's obligations. Sometimes it does, but often it doesn't. In the 16th century, Spain borrowed against silver shipments from the Americas and repeatedly went bankrupt. France, before the revolution, piled up debt that eventually overwhelmed the state. Modern governments rely on bond markets and central banks, thinking that size and credibility provide protection. But debt is ultimately a claim on future work and production. When confidence drops, basic math comes back into play. Another common illusion is that economic systems can be designed without considering incentives. Price controls, wage freezes, and rationing schemes keep appearing during crises. Leaders think that authority can override market behavior, that shortages can be eliminated by law, and that people will comply with mandates. History shows otherwise. When prices are set too low, goods vanish. When exchanges are limited, black markets arise. These results are not moral failures. They are predictable responses to incentives. Still, the belief persists that enforcement alone can suspend economic logic. People often confuse nominal gains with real gains. Inflation takes advantage of this misunderstanding. When wages increase but prices rise faster, people feel richer while actually becoming poorer. Governments exploit nominal growth to claim success, even as purchasing power declines. Asset inflation creates a false sense of prosperity without actual increases in productivity. This illusion works because people think in absolute numbers, not relative values. A higher number feels like progress, even if what it represents has shifted. Time also plays a crucial role in maintaining economic illusions. Costs are often delayed, while benefits appear immediately. Political leaders enjoy rewards for policies whose impacts will be felt after they leave office. Consumers benefit from cheap credit today, while repayment comes later. Investors pursue immediate returns, hoping to exit before a collapse. This gap between short-term incentives and long-term consequences creates a fertile ground for illusions. The future is emotionally as well as financially discounted. Technology adds another layer. Each major technological change revives the idea that basic economic limits have been lifted. Railroads were thought to eliminate distance and scarcity. Electricity promised unlimited productivity. Computers and the internet were said to create value without needing capital. Now, claims about artificial intelligence are similar. While technology can enhance productivity, it doesn't eliminate trade-offs. Resources remain limited. Skills take time to develop. Distribution still matters. The illusion lies not in optimism, but in absolutism. Power and inequality further entrench economic misconceptions. Elites usually benefit more from bubbles, debt expansion, and monetary manipulation. Losses are absorbed by society, while profits are kept private. This imbalance encourages repetition. When those who shape economic systems are shielded from failure, illusions can last longer and surface more easily. History shows that many crises are not surprises to insiders. They are risks seen as acceptable, since the costs will fall on someone else. Cultural memory tends to be shorter than economic cycles. The ability to collectively forget is powerful. Each generation experiences crises differently, and lessons learned by previous generations fade as the new generation gains confidence. Regulations enforced after crises are gradually weakened as memories fade and lobbying grows. Stability itself becomes evidence that past warnings were overstated. The absence of disaster is misinterpreted as proof that safeguards aren't needed. This paradox ensures that repetition occurs. Education doesn't automatically eliminate illusions. Economic knowledge can justify mistakes as easily as it can prevent them. Complex models can obscure basic assumptions. Technical language can mask moral and political choices as if they were neutral. Expertise can lead to overconfidence. Some of history's biggest economic errors were made by well-informed individuals working in respected institutions. There is also a moral aspect. Many economic illusions stick around because they reinforce deep-seated beliefs. The idea that hard work guarantees success ignores structural barriers but feels fair. The belief that markets always reward merit flatters the successful. The notion that growth can continue indefinitely without harming the environment reassures consumers. Challenging these stories can threaten people's identities as much as their financial stability. Globalization adds complexity, but does not protect against these illusions. Interconnected systems spread misconceptions more quickly and widely. Capital flows magnify booms and busts across borders. Policies in one country can have effects in another. Responsibility becomes blurred, making accountability difficult. Each participant thinks someone else has judged the risk. This blurring maintains collective blind spots. Crises can briefly disrupt illusions. During financial crashes, wars, or depressions, economic realities become impossible to ignore. Trust evaporates. Numbers lose their significance. Barter returns. Survival takes precedence over speculation. Yet even these moments do not permanently eliminate illusions. As stability returns, narratives come back together. Memory fades. The cycle continues. Understanding why humans repeat economic illusions means letting go of the idea that mistakes are only technical. They involve social, psychological, and political aspects. They continue because they serve immediate interests, reinforce comforting narratives, and play on cognitive biases. Institutions aimed at managing risk can end up supporting these illusions. They thrive during stable periods when warnings seem distant. Recognizing these illusions doesn't ensure immunity. Awareness is helpful, but incentives still play a role. Even those who grasp the cycles often feel pushed to partake while they last. Choosing not to engage can mean falling behind colleagues, losing competitiveness, or forfeiting influence. Rational actions within an irrational system help keep the system going. History shows that progress lies not in completely removing illusions, but in reducing their duration and minimizing their damage. Transparency is important. Independent institutions matter. Diverse perspectives are vital. So is humility. The most dangerous illusion may be the belief that humanity has finally moved past economic self-deception. The historical record indicates otherwise. As long as humans are social, emotional, status-seeking, and short-sighted, economic illusions will continue to appear. They will adopt new technologies, new language, and new symbols, but their structure will remain recognizable. Understanding this pattern doesn't eliminate it, but it can help us see it sooner, question it more rigorously, and possibly endure it with less pain. Economic history isn't a series of solved problems. It reflects human nature. The numbers change, the tools evolve, but the illusions